Well, you want to own a smartphone company like Apple. You are thinking, you will design a sleek device, slap your logo on the back, sell it for a markup, and watch the money come in every time someone upgrades. It sounds almost insultingly simple, like building a nicer calculator and charging $1,000 for it. But you don't know the real story behind it. The global smartphone market pulled in $628 billion in revenue in 2025 alone. But here's the twist nobody expects. One of the most hyped phone startups in modern history, backed by the actual co-creator of Android, raised $330 million, launched exactly one phone, and shut down completely within 3 years. That's not a metaphor. A founder who helped build the world's most used mobile operating system could not make his own hardware company survive. That gap between $628 billion of total opportunity and one of tech's most credentialed founders going to zero is exactly what this video walks through. By the end, you'll know why a phone that sells for $1,000 can still barely turn a profit. The one supply chain word that quietly wiped out a global company's entire product line overnight. And why 2026 is shaping up to be the industry's worst shipment year in over a decade. Before you design a single prototype, understand this. A smartphone company is not, fundamentally, a hardware business. That sounds strange, since the entire product is a physical object you hold in your hand, so stay with it. What you're actually selling is a guarantee that this exact glass and metal object will keep working flawlessly, stay secure, and receive updates for years, regardless of which factory in the world it rolled off of. The glass is just the surface that guarantee sits behind. Every dollar you spend either protects that guarantee or quietly threatens it. Let's talk about what it costs just to exist. The bill of materials, the raw components alone, for a modern flagship phone runs around $416, according to teardown analysis of a recent 256GB flagship model. Add assembly, packaging, and testing, and total production cost climbs to roughly $485 per unit. That sounds manageable for a device retailing at $1,199. It is, on paper, until you realize that number covers exactly one unit, assuming you already have a finished design. Getting to that finished design is its own brutal cost. Company-wide research and development spending for a major smartphone maker regularly exceeds $31 billion a year, covering custom chip design, camera engineering, and software spread across an entire product lineup, not just one phone. Then comes certification, the part nobody warns you about. Every carrier network a phone connects to requires its own certification process, and getting a single new device approved across multiple carrier networks typically runs anywhere from $100,000 to $2 million in testing and compliance fees. Skip a certification step, or fail one, and you're not looking at a fine. You're looking at a phone that legally cannot connect to that network at all. No matter how good the hardware is, add it together, and a genuinely credible smartphone launch, one single flagship model, easily clears tens of millions of dollars in R&D, tooling, and certification before a single unit has shipped. That is the cost to exist in this business, and the box, the actual retail packaging, is the cheapest part of the entire process. Now the cost to operate, and this is where owners get blindsided. The single largest recurring cost is labor, specifically assembly labor, and the sticker number is deceptive. Foxconn, the contract manufacturer behind a huge share of the world's smartphones, employs well over 1 million assembly workers across its facilities. Following a wave of worker suicides in 2010 that drew global scrutiny, Foxconn raised base assembly wages multiple times, moving pay from roughly $130 a month towards several $100s a month, plus overtime, benefits, and dormitory housing costs that rarely make it into a simple per-unit labor estimate. Multiply that across a workforce in the hundreds of thousands, and labor becomes a permanent, unavoidable cost floor no design tweak can shrink away. Add component sourcing, since memory chips, camera sensors, and displays are bought on global markets whose prices swing with almost no warning. Add warranty service centers, software update infrastructure that has to run for years after a phone stops being sold, and the packaging and logistics to move tens of millions of units globally. Stack it together, and it becomes clear the retail markup was never the easy profit it looked like from the outside. Here's the mechanism that quietly guts more phone companies than bad reviews or slow sales ever could, and it's called the recall risk. Think of it like a restaurant that has to personally track down and refund every single customer who ate a specific dish, going back years the moment one ingredient turns out to be dangerous. In 2016, Samsung's Galaxy Note 7 had a battery defect that caused some units to catch fire. The company issued a full global recall, then discontinued the phone entirely at an estimated cost of $5.3 billion in lost profit and cleanup. Most small phone makers never model what happens if a single component defect forces a total product recall, and it alone can erase years of accumulated profit in a single quarter. The revenue model on paper is beautifully simple. Take your retail price, subtract your per unit production cost, and multiply the difference by units sold. A phone selling at $1,199 with a $485 production cost nets roughly $714 in gross profit per unit. Sell just 1 million units, and you're looking at $714 million in gross profit. On a spreadsheet, that's an extraordinary business, but that formula assumes every unit produced actually sells, and that's exactly where the real economics diverge. Two phone companies with identical production costs and identical retail prices can post wildly different results based on one number: sell-through rate. How many units actually reach a paying customer versus sitting unsold in a warehouse? A company selling 95% of what it manufactures captures nearly all of that gross profit. A company that only sells 60% of its production run, forced into markdowns and inventory write-offs on the rest, watches most of that same profit evaporate into discounted, unsold stock on the exact same device built at the exact same cost. Let's look at what this did to real operators. Essential Products, founded by Android co-creator Andy Rubin, raised $330 million in funding from investors including Amazon and Tencent. The company released exactly one phone, the Essential phone, in 2017, then spent years trying and failing to ship a second device before shutting down entirely in February 2020, writing in its own farewell post that it had no clear path to deliver its next product. The lesson: even a founder with unmatched industry credibility and 9 figures of funding can't outdesign an industry with margins this thin and a market this saturated. Then there's the macro shock hitting the entire industry right now. According to IDC's 2026 tracker, worldwide smartphone shipments are forecast to fall 13.9% for the year, driven largely by memory chip supply constraints and rising component prices, breaking a 10-quarter growth streak that had held since mid-2023. The lesson: even the biggest players in this industry have zero control over a component shortage that starts on the other side of the global supply chain. Scenario 1, everything goes right. A flagship phone with a $485 production cost, retailing at $1,199, selling 95% of a 2 million unit production run. Revenue, approximately $2.28 billion. Production costs, approximately $922 million. Net profit, approximately $678 million after marketing and overhead on that single model. Scenario 2, the realistic version. Same phone, same production run. This time, a memory chip shortage pushes your component costs up 18% mid-cycle. A competitor's launch pulls demand away, and sell-through falls to 60%, leaving 40% of your run to be marked down 40% to clear inventory. Revenue, approximately $1.3 billion. Production and markdown costs combined, approximately $1.1 billion. Net profit, approximately $80 million on the exact same device. The gap between the good year and the bad year is roughly $598 million on identical hardware. Only the chip market and the sell-through rate changed. In 2010, Lei Jun founded Xiaomi with a promise that sounded almost reckless to industry veterans. The company would sell phones near cost, capping overall hardware net profit margin at 5%, a pledge it later wrote directly into its 2018 public stock offering documents. While competitors chased fatter hardware margins, Xiaomi understood the actual reframe correctly, that the phone itself wasn't where the real business lived. The real business was the trust built by selling a genuinely capable device near cost, then earning revenue afterward through internet services, software, and a broader ecosystem of connected devices built around that same trust. That single decision, treating the phone as the guarantee rather than the profit center, turned Xiaomi into one of the largest smartphone makers on Earth within a decade. Step back for a second. The glass is just glass. Anyone can assemble a screen, a chip, and a battery into a slab and put a logo on the back. None of that is the business. The business is understanding exactly how much of your guarantee is protected against a component shortage, a defect, or a warehouse full of unsold inventory. Right now, somewhere, there's a container ship carrying 1 million units of a phone nobody has bought yet, produced at full cost, floating toward a market that may have already moved on.